Welcome. Here we are again with another trading video by Black Bear Dog Trading. Today I am not actually going to go into a trading routine or see if I can actually go into a trade, but I want to talk a little bit about when you should trade and what you should trade, which currency pair. There is a lot of information on the internet that tell you which time frames you should trade, which hours you should trade, and which currency pairs are the best, and so forth and so forth. Personally, I come to find out from doing this now 15 years that there is only one answer to this, and that is which one suits you the best. The currency pair, the time frame of your chart, as well as the hour that you trade, is all dependent on your own personal preference. So it is completely individualized, and it depends on yourself, what you like the best. However, there are some guidelines that you can take under consideration. I like to trade the Euro USD and the USD JPY, as I mentioned already in a prior video. And because I like to trade those two currencies specifically, I tend to trade during times when those currencies offer the most potential for having an actual trade. As far as the Euro USD is concerned, that happens to be when the London market overlaps with the New York market. And there is a specific hour period or hours period, it's about 4 hours long, give or take, where the London financial market overlaps with the United States financial market, the New York Stock Exchange. And those are the times when the two overlap that will offer the most liquidity, the most volatility, the most opportunity to enter a trade, a position, and make profit. It also offers, of course, more risk because there is more volume being traded. It goes a little faster. Price moves a little faster. So there are things to consider, but based on my personal preference of wanting to trade predominantly the Euro USD, I tend to trade during the overlap of the London market and the New York market. And being that I'm on the West Coast and I'm under Pacific Standard Time, that means between the hours of 5 a.m. in the morning and 9 a.m. in the morning, with the peak of that being from 5 a.m. to about 7 a.m. Morning hours. As far as the USD JPY, they have a similar overlap, which is in the evening for where I am. And that overlap is, let me see, I wrote it down, what the hours are. I don't want to misconstrue here. That overlap tends to be when 5 o'clock in the afternoon comes around and going up all the way to 11 o'clock at night. There is no specific peak time there. It's a gradual thing. The Japanese yen does not move as erratic as the euro does during peak performance. It's a more stable, a more subtle movement of price. So, but those are the two time frames that I most often trade. Now, does that therefore mean that I will never ever look at a chart outside of these hours? Of course not. I do look at the charts, and I do look at potentials, and I do look at possibly entering a position. And after all, that's the nature of the beast. I'm in business of trading, and that business is to make money through trading. So the more I can earn with my trading, obviously, the better and the more successful my business is. But again, getting back to where I started this video, I trade from 5 in the morning till 9 in the morning, and then again from around 5:30, sometimes 6 o'clock, but till about 11 o'clock in the evening. And again, that's Pacific Standard Time. So I don't know where you are in the world. You would have to adjust that for your time zone. But and again, what type of currency pairs you would like to trade. Now, as far as time frame on a chart is concerned, that is also entirely up to you. I like to trade the 30-minute chart. It moves a little quick, especially in the morning, but I like quick action. I don't like to sit in front of my computer and see price move like molasses dripping out of a container. It's just painstakingly slow, and while I am very patient, I don't have that kind of patience. So for me, I prefer the 30-minute chart. You need to play with it. There are pros and cons. The shorter the time frame, the faster price will move, the higher your risk potential of going into a bad trade, the better risk management you should have in place to minimize your losses. The longer the time frames, the more potential there is for longer runs, meaning positions stay open longer. The process is a little slower. It gives you more opportunity to get out of a trade. It also, the risk management rules, while still important, they're always important, aren't as strict and as tight as they are with shorter time frames. So it's a matter of preference. How do you find out? Only one way: practice and see what you get, and try different time frames, try different currency pairs, try different techniques, whatever. Nothing is set in concrete when it comes to trading. And as you gain more experience, you'll come to find out that you actually, over time, will take bits and pieces of things that you learned and put it together as your own method of operating, your own method of trading. One thing I will say, though, that should be a standard for anyone wanting to be in the trading business, and I don't care if you trade stocks, bonds, commodities, or in my case, a forex, take it seriously. Look at it as a business, manage it as a business, operate it as a business. Yeah, take it seriously. So, okay, I hope that video gave you a little bit of trading wisdom, trading insight, and I'll see you in the next video. Take care, be safe, and God bless.